My name is Michael Guyett, publisher of the Lead Lag Report. Joining me for the hour, Mike Shell, who's got a great following and a really interesting way of looking at markets. But Mike, for those who are not familiar with your background, just introduce yourself to the audience as far as who you are, what you did before managing money, and how you manage money today.
Well, the short version is what I did before was I actually joined the Marine Corps after high school, got injured, got out, got an advanced accounting degree to sit for the CPA exam, became interested in the markets during that time, which was in the 90s. Introduced to CanSlim and IBD, relative strength, trend, momentum, and all that in the 90s. Became a professional in the late 90s and was a registered principal at Raymond James and registered options principal. And then afterwards, around 2004, started Shell Capital Management, which is a registered investment advisor, and did that in order to manage this specific investment program, which is Asymmetry, managed portfolios, Asymmetry Global Tactical. So I started out very discretionary stock trading, moved into ETFs very early. And when the tactical ETF area of the market was very popular after 2008, I'd already been doing it for 10 years. And so I developed systematic programs around 2003, 2004, 2005. And so I've got a unique background in that I'm a discretionary stock trader, but also a systematic trend follower and momentum, and also trade volatility. So I construct trades or can construct trades using options, for edge as opposed to just trading the underlying. So that's pretty much a summary of it. So now we manage money for just a few clients. We've kind of a little more in a kind of a lifestyle stage at this point, and so not really looking to add clients or anything. But I thought I'd get on here and help with this bear market conditions. I know a lot of people are struggling, and these kind of periods are where I've actually shined the most. I mean, when the markets are going up, I'm trend following and pretty much doing similar to what other people are doing. But when we get into these real difficult periods like this is where I tend to shine, and it's where I focus the most because, like you probably, I started in the late 90s. So I participated in this massive bull market and then a crash. And fortunately, I had learned how to manage risk through the IBD methodology. CanSlim, was the initial, but I learned how to manage risk, before that big decline after 99, after 99, which is 2000 through 2003. So I went through that period. And then of course the 2007, 2008, 2009 period, which is where I really, became more known, I guess. And so that's the people that know me in investment management. We're very low key, but the people who know of me know of me mostly, I think, through that time frame where I was able to, pull out some my risk management methods, really made a big difference in these bear markets, and just like this year too. So,
okay, so for those who are not familiar with CanSlim, just outline what that methodology is and how maybe effectiveness of CanSlim may have changed from the 90s to today.
Well, that's the momentum growth stock trading is just a piece of what I do. So I want to make that clear. Our managed portfolios are heavy also in ETFs because I started trading You probably may remember back the RIDEX funds and the Pro funds in the 90s into early 2000s were the thing for sector rotation and tactical trading because you could trade those funds, and then ETFs kind of took over. But the CanSlim thing was what I learned in the 90s as a young, in my mid 20s. And it was, it's more designed, first of all, find the stock that you're going to buy and put an 8% stop loss. Now, I did that back in the day, but I've gone far beyond that now. But you certainly, it works. I mean, if you put an 8% stop loss on all your positions, you're not gonna have too many decline, losses larger than that, and you're going to ultimately, if you do it correctly, you're going to end up with a portfolio of gains as opposed, and you're going to cut your losses short and let your winners run. That's ultimately what CanSlim is doing. It is a trend following method. It's just not the same kind of trend following as my friends like Jerry Parker, who's a CTA trend follower. They're trading longer short 100 markets. But the CanSlim is looking quantitatively. They screen for the high earnings growth, 25% quarter over quarter, annually. They're looking at earnings growth and all the things that William O'Neill, the founder of Investors Business Daily, discovered leads to the biggest outperforming stocks. And he had done all these massive model book studies going back 50 plus years, and determined there's certain criteria like earnings growth and sales growth, new products, and then there's also the bigger ones are relative strength. That the stock is just literally outperforming other stocks, and then of course the pattern recognition, which is there's certain chart patterns like the cup with handle, where a stock runs up and then it pulls back into a base and kind of forms sort of a cup looking pattern and then a handle on the right where it drops and pulls back, some of that, and then breaks out to the upside. That's a very common, and really what that is, it kind of matches up with Stan Weinstein's, stage analysis, where one of the biggest things I think is key when looking at price trends is, you have uptrends and downtrends, but you also have those sideways bases. And so when a price trend breaks out of those bases up or down, that's usually when you're going to see some of your biggest moves. Now, CanSlim, there's a very, very, it's a discretionary. It's systematic to the extent that it's rules based and it's quantitative. But people aren't necessarily doing it mechanical. If you, I believe in discretionary trading of, seeing a signal, see it looks right, give you a feeling about it and pull the trigger, by looking at charts and things. That's where I started. And I was good at that. So fortunately, because I was good at that, I was able to then develop systems that are completely mechanical systems based on the knowledge that I gained through understanding trends. Well, CanSlim, in theory, you ought to be able to take any strategy that anyone does and look at what all the rules are and develop a completely automated system that enters and exits and sizes those positions, and you ought to be able to run it mechanically. Now, the AAII, American Association of Individual Investors, has been tracking CanSlim just directly from the information that Bill O'Neill put in his books, How to Make Money in Stocks. They've been tracking it for, gosh, probably over 20 years. I hadn't looked at it lately, but I used to kind of follow how they were tracking it. And they're running it more systematically in that you may have, it's usually only going to be in 3, 4, 5, 6 stocks. And that's another thing about CanSlim is that I completed the CanSlim Master certification with William O'Neill and his team, Mike Webster, and a lot of other people that are still at IBD today. Back in, I think, 2005 or 2006, I started it. It took about a year or so to do it completely. And then I attended, I know in 2006, I went out to Santa Monica and attended the actual live class with Bill O'Neill and his portfolio managers and the team at IBD. And then I passed the exam, got the CanSlim Master certification. I already had been trading it for nearly a decade before I actually did that, though. And I think that for those who, I'm very broad in my strategies. I relate a lot to CTA trend followers like, Jerry Parker, who does a lot of these spaces. I've done some with Jerry. I'll probably do one this week with him. I also relate though with the IBD folks because I like to trade stocks, on a discretionary basis too, which I do more for myself or in the fund that a hedge fund that I started in 2012. But the I really, I'm really focused on asymmetry and asymmetric returns. So I really don't care so much about how I get it. I'm not dogmatic about any one strategy. I'm really willing to to do whatever alternative trading strategies that I think will lead to asymmetry. And I think that with Can Slim, I think what you'll find if you're like me and look at the our universe of the market very broadly, some of the best traders, I think, stock traders, are all somehow connected to that one same person, which is William O'Neill and Investors Business Daily. And I think starting off that way was a huge edge for me because, by the way, I don't ever talk about my college background because I have an advanced accounting degree, which means I have all those extra kind of master's degree level classes in accounting that you had to have in order to sit for the CPA exam. And so I know fundamentals. I mean, accounting background. I never was an accountant, by the way, by trade, but I certainly know fundamentals because I know how to create reports. And when I look at a financial statement, I visualize what's inside of there. And what I learned early on in the 90s was that what I know about financials and fundamentals did not relate to the auction market because really your fundamental analysis is more focused on investment banking. So if you're at an investment bank and you're looking to help a company go public or lend money to them, you want to do channel checks. You want to know who they are, who their customers are, suppliers, and all that. Those things are really important if you're going to lend money to them, and all. You're trying to have it's a more fundamental thing. So I call that investment banking. When you take that and you put it into the stock market, which is an auction market. I grew up, had a very good friend of mine when I was young, still today had a car dealership, used car dealership. We'd go to car auctions every week. And so that's an auction. And, when you're in an auction market, it doesn't matter how much you think that car is worth. It matters how much the other people around you think it's worth. And that's where the price is going to come. And so, all those things together kind of made me realize that it didn't matter how good of a fundamental analysis I could do and discounted cash flows or whatever on a company stock. The market is going to tell me what it's really worth. So the market's always right. And I've adhered to that my entire career for probably 25 years now. And, I think the price trend ultimately is the final arbiter. And, every time I've ever argued with the direction of the price, it's always worked out, wrong. So, I've been saying recently, I'm a trend follower 95% of the time, and 5% of the time I may run counter trend strategies because I do believe that while I do believe in following trends, there are unique opportunities at times when the trends get to an extreme, overbought or oversold, gone up too far too fast, or gone down too far too fast. And that's what I usually write about on Asymmetry Observations, which is my blog. I've not been as active on it in the last year or two, but that's normally what I've historically shared is when I see the trends go to an extreme based on sentiment and things like that, momentum, then I will then become a counter trend trader where I may start to construct some positions that will take advantage of the opportunity of the probability becoming much higher that trend may reverse and go the other direction. Now, my trend following friends hate to hear that, but it is what it is. I mean, that's just something I really enjoy sentiment, and I spend my discretionary time, the time that that Mike Shell is actually looking at the markets, is spent reviewing sentiment and those kind of things. The trend stuff and momentum is all systematic, quantitative, whereas the sentiment is partially quantitative in that I've got lots of different indicators that I look at, but then there's also some qualitative, more intuition involved in in looking at how other people are acting. And I'll tell you, that's why I'm on Twitter, really. I mean, the Twitter for me, I was back in the 20 or so years ago, I was really active on the Dorsey Wright platform, which is point and figure charting. Because after I learned Can Slim, I wanted to, Can Slim, that was the first real exposure that I had to investing in stocks and trading and all that after and during my college schooling. And so and it resonated with me very much because I liked fast cars and momentum and trend. I think you have to be a person that wants to drive the cool, go to the racetrack and drive the car on the track at Road Atlanta or down here Sebring in Florida. You have to be. I think that there's certain characteristics and personality traits that attract you to one thing over the other. And so the momentum and trend has always been big for me. But at the same time, if you drive your race car around the track at 200 miles an hour at Sebring, and you come into a turn and you don't have brakes and you don't know how to get through the turn, you're going to have a problem. Okay, so
Well, so that's actually a good analogy. I think on this point about brakes for a moment about when it comes to this year. But there's a lot you said there. I want to kind of branch off in some directions here. So first of all, on the point about being systematic, obviously that means you're back testing, right?
yes,
And I always make it a point that if your back test is a 45-degree line, it's a failed test, right? In
yeah,
other words, back tests need to have drawdowns and periods where the back test isn't working. But I want you to talk about how you think about back testing for a moment. How do you go about back testing? And in that process of doing iterations of back tests, does it make you maybe cynical, as it does for me, in hearing people trying to explain why markets do what they do?
yeah, absolutely. And I tell you that this is a topic we could talk for hours on because and I'm going to be very blunt about it. I know that I have friends who are purely back testers, quantitative trend. That's all they do is mechanical. And then I have friends who are purely stock traders. The highest performing in traders that I've ever seen are the ones who are very good focused stock traders. I mean, when you're getting into the people that are putting out 100% annual gains and can do it several years, that's usually going to be somebody who's throwing 20% position size into 5 positions at a time, fully loaded, and they're usually not even fully invested all the time. So that they're very very focused, and that's probably the most profitable, but also the higher risk because obviously you can have a crash and it take you out. But the back testing part though does not test well for that kind of strategy because there really is a human skill, a human element, and I've not even completely figured all that out myself, and maybe never will. But yeah, back testing. I started back so in the late '90s, going into the early 2000s. It's around 2002, 2003. Somebody said to me, "How do you know? Yeah, you've done pretty well here, but how do you know that you have an edge that'll continue into different markets because we were in a major bull market." And that's what led me to start learning about back testing. And I reached out to programmers and started testing the various strategies that I was doing on a discretionary basis. You got to realize back then I was doing relative strength ratios with point and figure charts. I started out doing relative strength ratios with line charts and just deciding, is this one up more than the other, that kind of thing. And then we started comparing, different trends to each other using those same methods, and then started using point and figure charts to kind of give a more defined signal. But they were very difficult to test now, or at least, and of course, point and figure chart three. There's a percentage change that causes the underlying reversal of the trend using a point and figure chart. Normally it's about 9.75% change in between the two that causes the signal. But anyway, that was very hard to test. So I started testing, and and also testing. But here's the real kicker, I think, when it comes to testing, is that I tested not just the signal. I think the academic papers are all focused on they're relying solely on the momentum. Jagadish Titten, said, stocks that perform well 3, 6, 12 months tend to perform well over the next, 3, 6, 12 months. But that's only looking at the factor of momentum, And what they fail to do is they fail to look at position size algorithms, which is the single best thing that I've ever done, and the biggest edge that I have for asymmetry is my position size algorithms and my risk management exits and things like that. That has always been the true edge for me. The stock picking and ETF picking is the least important. It's what I do once I get in it is what makes all the difference, and that's what I call portfolio management. Some people call it money management. But when you get into testing, I was starting back then. I was looking at testing all kinds of things. I started out trying to test stocks. Now, stocks you could only do trends because you didn't have the fundamental information. Nowadays you can get more of that, but I started testing ETFs and funds. We would test like Ridex funds back and I mean we're talking like 2003, 4, 5 here, because that Ridex was the only thing that had much history, and also pro funds. But the sector funds. But we started testing those, and there wasn't enough data because I really, one topic that I love the most in school is probability and statistics. I really enjoy in a lot of the, like algebra, the y-intercept slope and things like that. For some reason I've always been drawn to those kind of things, but I really love probability, and which of course comes into sample size. Well, the sample size is really slow, so I just get or really small, so I get the index data because the ETS, spiders, and all that wasn't out long, and then iShares was coming out. So I would use the indexes to test. And what I was really trying to determine is what entry and exit signals would capture the trend, the part that I want, and avoid the part I don't want. Like Michelangelo took a block and chip away and take the parts away he didn't want in order to discover the ones that he did want, which is precisely what I do with risk management. When I go and test, though, when you're back testing, you're applying a systematic methodology that's very stringent to the historical markets. And there's just all kinds of issues. I used to kind of speak negatively about back testing because after 2008, as you know, all the financial advisors and investors in the country were running around looking, or in the world for that matter, running around looking for something that looked good on paper that did well in the past. Well, they didn't have it. They didn't have the performance of a few of us that actually did well during that time. So they were back testing. And what happens is when you're back testing, it's very, very difficult. You got to really have the right mindset. You have to be extremely humble and be very, very honest with yourself, because it's very easy. I could go in here and create the most killer back test in the world. I mean, it's not hard to do. We know what did well in the past, and all you got to do is include those in your universe and test it, and boom, there you go. I mean, so there's tremendous amount of issues with quantitative analysis and testing and all, and so while testing is a very critical scientific mathematical process that I think is very, very important, I think that the limitations and the psychological issues that come along with it are actually worse than discretionary trading. And what I mean by that is discretionary traders all needs it's a lot of psychology. You got to really be focused. You got to have a tremendous amount of discipline for that. And a lot of discretionary traders eventually blow up. They get too arrogant, get too focused on a certain stock or something, and they get hammered at some point. Systematic trading is more piranha bites. They tend to get more whipsawed. And I think that what happens is when people are testing is they, especially if you're, if you really believe in the process of back testing, then you're hoping, what you're really hoping is that the future is going to look like the past. So you're testing,
right, and you're hoping the causation of the relationships that you're back testing persist. Right. That's always the key. Like in the case of indicator, right? The causation is very clear. It's around housing, right? Because the average home has 16,000 board feet of lumber, and gold historically, more often than not, is, at least for a moment of time, kind of a safe haven asset. So as long as the causation in the future remains the same, you can have some degree of confidence.
Yeah, and it is all, it's probabilistic, not a sure thing. So you're dealing with probabilities. But here's the caveat for me. I've always focused on, I like absolutes. My objective is absolute return, not relative return. I focus on absolutes, and I focus on what things can I truly avoid getting killed. And so I only use, I don't use anything. There's something I've said for 20 years now is that the anything outside of price itself, the trend itself, has the potential to blow you up. Anything that you're relying on to generate a signal outside of the direction of that trend has the potential to lead you astray. P ratios, correlations, whatever, all that stuff is not absolute. It's some assumption that that's not only that the trends. See, I'm focused on trends in the past and saying that they may not repeat in the future the same. And we have different kinds of overall market states. You have trending and volatile, trending and quiet, non-trending and volatile, non-trending and quiet. You have uptrends, downtrends. When you start introducing into correlations that you're hoping that will persist, then I think those are the kind of things where you better have a good absolute risk management methodology to apply to it, because they could really put you down the wrong path, because things can happen that have never happened before. And for me, I really, at the end of the day, relative strength has never been that. Relative strength has been a major part of my strategy for 25 years, since I started in the 90s, because that's a major part of canceling, probably the number one piece. However, relative strength, just like my friend said, Dorsey Wright, during the 2008 crash, it really doesn't matter if you're rotating into what was doing the best in the last 12 months. If those things are going down, you're going to lose money just like everybody else is. So you really got to have an absolute to apply to it. I prefer to focus on absolute trend. I also always have my exit systems, my risk management systems are always focused on the actual risk of the position, which is based on the price trend itself. And then there's a volatility function that's in there to prevent me from setting an exit point that's too much, that's too much inside of the normal noise of the market. So, like right now, the S&P 500 is trading in a range of, around 2% or so over the last 15 days. Well, if you put a stop in at 1%, you're probably going to get popped out of it, because you're inside. It's moving at an average of true range of around 2%. Day over day, on average. So you're probably going to be too tight at 1%. So you're going to need some multiple of that to get outside that normal noise. But otherwise, it's based on trend. I think that when you're looking at testing, and I talk about these topics more with Jerry Parker and his trend following spaces that he's been doing, I think on Friday mornings. I've done a couple of them with him. When you're doing testing, you're trying to, the objective is to apply a systematic, scientific, mathematical approach to see if you have a mathematical basis for believing that you have an edge or not. The trouble is, everybody always does the same thing, just like I did. We all are going to do it. You're always going to go in and just like the old school brokers back in the 90s, they would sit and run the hypothetical of how these 5 or 6 mutual funds put together would have done. Well, naturally, they're going to go in there and do what? They're going to find it's going to be the Van Kampen Emerging Growth, the Putnam New Opportunities, the Janus 20 fund back in the day. And they're going to show the clients how, if they had invested in that 10, 20 years ago, how much, millions they would have made on their $10,000 investment or $100,000 investment. People do the same thing with back testing, but it's even on steroids the way that we're doing it, because with back testing, you're not just doing a hypothetical of, well, if you invested in these things 10, 20 years ago, here's what it would look like today without doing anything to it. With back testing a system, you're testing the entry, exit, and the size. And so, you're able to literally generate your own unique return stream. When I look at testing and building a system, the system itself, which I call asymmetry, because my pursuit is asymmetric returns. The system itself doesn't care what I give it. It doesn't care what I feed it. What I'm looking to do is just feed data and price trends into it and it's going to spit out the asymmetry at the other end is what it's designed to do. And like you said, it's not going to do that perfectly all the time. I think all hedge funds, tactical trading programs, CTA trend followers, I think everything that's not buy and hold the S&P has had some years in the past decade where they've underperformed certainly the S&P because it's long only invested all the time with no risk management at all, which you're seeing that the perils of that this year. But the way I look at things is I can take that same trend that the S&P creates, or even better, the underlying sectors inside of that S&P, or even better, the underlying stocks inside of those sectors inside the S&P, and apply an entry, exit, and sizing system that will extract the parts that I want from the parts that I don't want, which means try to avoid the downside and capture more of the upside. And so that's the advantage of trading systems. And I think that, by the way, is what Jim Simon's group, Rentec, is doing. I also think that's what Bridgewater does to some degree as well. Is they're taking normal commodities, stock, whatever, in stocks, indexes, whatever it may be, and they're applying trading systems to create their own unique return streams. Because, like, for example, Ray Dalio at Bridgewater had Bloomberg interview recently, and I've seen him running like a commercial. It's a couple of minutes where he says something along the lines of, taking 10, say 10 or 20 unique return streams and putting them together. And it's like a symphony, where you're putting them together, and those unique return streams, putting them together is where the edge is. And what he's saying there, that's not allocating, some amount to stocks, bonds, and whatever. That's going a lot beyond that. It's developing trading systems that you can combine these different trading systems that do different things to different markets and market trends, and you combine them together, and you have something that is truly unique. And that's really what I've done. Is I've got I developed 35 systems, initially, and then I dropped 2 of them down to 33, and this is like sector trend following, sector rotation, countries, individual countries for my shares and all these things, commodities. I could do. I'm not a CTA. I'm an RA, but I could do commodity long and short. Like the trend follower CTAs do. But really, what the systems are doing is you're trying to take what's there and extract the parts you want from the parts you don't want. And the trouble, though, is that we a lot of people are willing to fool themselves, and I'm just not. I think it's been an advantage for me that you have to be extremely brutally honest with yourself when you're doing this stuff, because the natural tendency is to pick the one that shows the best risk reward or risk adjusted returns. But most people are not even going to focus on the downside, because you don't really know the downside until you experience it. Just like right now, I mean, I'm kind of shocked, to tell you the truth, this year, that the stock and bond indexes are both down, or about 20%. Actually, the long treasuries are down even more than the S&P.
You are not the only one shocked by that. That's been I've called that my hell many
Well,
times over.
I tell you though, Michael, the thing is, what I'm shocked about is that the sentiment is so bearish and so down over just a 20% decline. And that's something else I want to talk about is that part.
Let's tease that out, because I think part of that is because it's been like a tale of two markets, right? So you've had I've since at this point that I believe the bear market really started February of 2021, because that's when breadth started weakening. That's when the speculative names that ARK was in started peaking. That's when small caps started going sideways, emerging markets peaked. So when you look at the vast majority of stocks, they've actually diverged pretty meaningfully on the downside versus the S&P, which only now is catching down maybe to everything else. So to the extent that the sentiment is being driven by people who are stock picking outside of the mega cap 5 stocks, it kind of makes sense that the bearishness is so high because of the devastation beneath the surface.
Well, that's true. Yeah, the internals are, and I've posted about this several times on my Twitter. and which I've been doing more lately than I have an asymmetry observations blog. It used to be before that I had one, asymmetric investment returns, which was like 10 years ago. But um, I've talked about the internals a lot because something that I followed again since the late 90s is are the internal breadth. So started out looking at firms like Dorsey Wright were doing bullish percents, and also Investors Intelligence, which is very similar to Dorsey Wright. They've all used point figure charting and bullish percent. So a bullish percent index is looking at like the NYSE or the NASDAQ or individual sectors, and it says what percentage of the stocks inside of this basket are on buy signals in an uptrend, and what percentage are on sell signals in a downtrend. Well, later on, I started doing that with moving averages, which is what I do more now. How many stocks are above or below the 50-day, 100-day, 200-day, that kind of thing. That breadth, I've been watching that for over 20 years now. And I mean, that's one of the biggest things that I've actually monitored, along with momentum and stuff, because that's where a lot of my signals for counter trend comes. And I've written significant pieces on it, on asymmetry observations, especially if you go back and look at March 2020, which I just posted something recently about this. But March 2020, I wrote a big one because everything got so washed out. And then back in December 2018 was another one that I commented about how everything had gotten so washed out, and those things had some predictability in terms of where the bottom is. The trouble is where we are right now, the market is very, very washed out because as you say, all those individual stocks have been smashed. But and that's most people's experience. If you got a portfolio of 25 to 50 stocks, you probably are down more than S&P most likely. But where we are right now is that those things are extremely oversold. So, for example, when I look at the percentage of stocks in the tech sector, the S&P tech sector, that are above the 50, 100, 200-day moving average, there's very, very few. I mean, it's the most washed out level it's been really ever. I mean, you're down to about zero. In other words, there are 0 to 5% of the stocks in a lot of these sectors, like consumer cyclicals, tech, the prior leaders. I mean, there's like less than 10% of those stocks have been in an uptrend for the past 6+ months. And like you said, talking about that divergence starting last year, I totally agree with that, because I was seeing that roll over. I think what we have here, it looks to be, I don't try to predict. I don't need to predict the long trend of the markets, but I'll say that it looks to be the early stage of a much bigger, longer, prolonged bear market here. And I said that, by the way, in 2007, going into 2008. And it reminds me a lot of it with a dose of the euphoria that we had in 99. In 99, we had that euphoria for the technology, internet stocks, and remember Lucent and Nortel and everything fiber optics, everything connectivity. I had a good friend. I had a friend back then that was a major investor and pretty famous for connectivity and all that back in the day, in the late 90s, and those things were all the craze. And I mean, it was incredibly euphoric. I mean, literally had grandmas coming in with CD money, wanting to invest their bank CD money in high tech stocks and semiconductors and everything else. Well, we've got that now, but this time it's Bitcoin and cryptocurrencies, which I've been monitoring, but I've not done anything with. And you've got a lot of this, and then you've got a lot of the younger generation. I think it's really awesome. I'm really, the reason I'm doing this call is I'm really in favor of people trading and investing and doing it themselves if they can. I'm all for that. I mean, you don't have to have a money manager if you really think you can beat them, and most of them you are going to beat because they're just tracking the index anyway. So, but I also think that you got to be very cautious when you're inexperienced, whether you're young or old. If you lack the experience of bear markets, you'll get crushed in this. I mean, 2008. I was intimately connected with 100 to 200 other PMs during 2008, tactical PMs. And I mean, like the Dorsey Wright group, people from IBD, Can Slim, that method too, multiple directions. The National Association of Investment Managers, the last time I did a public speaking engagement was September 2008 for NAME, their ETF trading symposium in Atlanta. And my topic was exits and risk management. And that was the very same time that Lehman was failing. So, uh, you know, during that time, there was only a very few of us that actually got through that period well. And in experiencing that day after day, you can never back test through that. I mean, you can set and back test through bear markets all you want, but until you know the feeling, because you're going to feel your feelings. That's another thing that's unique about me, is that, in the way I believe, or different than a lot, is that quantitatively, you're going to feel your feelings one way or the other. Personally, I think that you're going to feel and experience your feelings even more when you're running a systematic strategy, because especially if you didn't just really create it and test it yourself, and just really buy into it. I really bought into my strategies. There were some that I thought could fail, and there's some that I thought could fail that actually did better than anything else. I mean, they were focused, and they were taking larger positions and fewer things. And you have to have a tremendous amount of confidence. And as Denise Schull, the trading psychologist on Twitter that's very active now, talks about a lot, confidence is an emotion. So you really have to embrace your feelings and your emotions, and do it in a way that, what I say is that I feel the right feeling at the right time. And that's kind of an intentional thing, because I never believed, I was never doing systematic back testing in order to try to alleviate emotions, because my emotional side was pretty in tune anyway, because I have a lot of personal self-discipline, and I study. I've never been unprepared.
And hold on, Mike, but let's go with that, because I want to focus on the word discipline for a moment, because
Yeah.
I often use that quote: "Your ability to stick to a strategy matters more than the strategy itself." Now, I know your background in the sense that you were in the Marine Corps, right? And discipline has got to be a key component of being in the Army, in the military, right? So
Right.
talk about the importance of discipline, because I think this is where people get tripped up. Even when you think about a back test, they employ it, and if they happen to employ it at the exact moment the back test going live is in a drawdown, now they start doubting the entire back test, even though there might be periods in the back test where there are similar drawdowns.
Yeah. Well, and that kind of, by the way, the again, when you first start back testing, you kind of tend to want to overlook the drawdowns, but the drawdowns is, if you go read asymmetry observations, you'll notice that since I've been riding, I mostly talk about drawdowns, and I'm really focused on drawdowns, because that's where asymmetry is created, by avoiding too much drawdown so that you can capitalize on the upside. And in the way that returns compound geometrically, you need the geometry to go with you, not against you. And so you really want to, compound returns are dramatically increased by the geometric nature of gains and losses. And so you really need to, I call it the asymmetry of loss. I hate to use my trademark in a negative way, but it's what it is. The asymmetry of loss is what you're trying to avoid. And when you really, I'm a math guy, and when you really look at the mathematics of portfolio management, that's where the edge is. But what people do is they focus too much on trying to create the upside. The Back to what you were asking, though. Well, say it again, because I got to thinking about.
No, just emphasize that point about discipline, because even if you're systematic and rules
Yeah,
based,
yeah.
the whole point of being
Well,
systematic and rules based is to be disciplined, right? But you always question that system then when it's not working for a moment in time.
well, let me say it this way, because I'm sharing my own personal experience. after 2008, there was a lot of advisors around the country that knew that I'd done well during that time. I mean, I wasn't no Michael Burry, and making billions of dollars in 2008, but I held my ground, didn't have much of a drawdown, and then and then I kept going. Well, we had a lot of advisors contacted me wanting me to run separate accounts for them and all that, which is, back then was far more complicated than it is today because entering multiple trades and multiple accounts. So I only did that on a limited basis. But at the end of the day, uh, the self discipline comes in where if you're going to run a system, you have to really. You have to be I don't know if Jerry's on here, but you got to be a Jerry Parker. Jerry Parker is one of the turtle traders that started, over 30 years ago. I know Jerry personally. We're both here in Tampa, Florida, and I've known Jerry for a long time. And he is extremely focused on what he does, which is the turtle methodology. That's made him a very, very successful, long track record history. The discipline comes in where the Marine Corps comes in, or any kind of training like that, is that you're a young guy or girl going into the military, and they're literally just making you do things every single day that you don't want to do during training. And that in and of itself is the single best part of it for me. Was close order drill. You're out there drilling at Paris Island, 8 hours a day with a rifle and sweating, and it's terrible humidity, and you're out there doing things you don't want to do. So you learn how to do what, and you end up with what we call in the Marines a 1,000-mile stare, which is you learn how to continue to do this physical or mental activity and do it more subconsciously. And that's where the 1,000-mile stare comes from. When you've been out there drilling all day with a rifle, the whole point of close order drill is to instill discipline and instant response to orders. And if you're not experienced that, then I don't know where you'd get it from. But I can tell you that it's helped me, uh, in that I'm able to kind of trigger this mode where I really, really get deeply into the zone and get very, very focused. And I'm also able to do things that I may not personally want to do when I need to. And that's the thing about following systems. When you develop a system and you're going to follow it, that's the key, is you got to follow it. And I'll tell you, one of the here at my firm, I have somebody who runs our systematic portfolios. Uh, we have our proprietary money in some systematic trading programs, and my wife actually, who was a bank manager for 20 years and been now with my firm for over a decade. She runs the systematic. You know why? Because she's not a technician. She's not a chartist. She's not an analyst. She don't think she knows anything about the trends. All she does is go in there and open up literally the system and see if it's generated signals, enter those trades to send to their brokers at Goldman Sachs to execute. And she don't think nothing about it. And in fact, after she does it, I can ask her what it bought and sold, and she don't even want to pay attention. Well, that is what you really need when you're running systematic strategies. And the firms who are running systematic strategies, they have traders who execute those systems. The main person, like say Jim Simons or Jerry Parker, is not going in and entering trades. They got somebody else whose job is to professionally enter those trades and follow those systems. The emotion comes in and the discipline comes in that even though it is systematic and mechanical, you still got to have confidence in it. And you've still got to have the commitment. You got to be fully committed. You got to keep running it. I've been running, 30 some odd systems now, for all the way going back to like 2004, 2005. And, now whether or not we have actual money in them, we don't have money in all of them. I play kind of a shell game, in that these systems a lot of times are informing my decisions, that may be a little more discretion involved. So, so we have all these systems that are purely automated that we don't veer from, and they must be executed with precision. So you actually want somebody who would just go in there and pull the trigger. When that person, by the way, who pulls the trigger on a systematic strategy, when they become a technician, start looking at charts and graphs and all that, uh, they will start to second guess the signals. The more you think that you're a good chartist, the more you're probably going to second guess the trend following system and signals. So those are the two, and I'm very, very aware of that, and I'm aware of when I do that myself, because I certainly do that myself, which is why I've got somebody else running the systems. I would be prone to go in and maybe not follow it completely, because I may think that there's a 70% chance that it's going to be a bad signal, so I might want to avoid it. Well, that might be the very one. The truth is, we never know what's going to happen next. And that may be the one big trade that makes all the difference for your entire year or whatever period. Does that answer the question? I think discipline
Yeah,
is really
yeah.
critical. But you know what, Michael? The thing is, though, too, when you're a professional money manager like we are, we're not just dealing with us. We're also dealing with other people. So it's not enough to do it ourselves. My biggest issue with the industry is being a professional. I enjoy managing money for other people, but we've kept it very small. I've always tried to stay under $100 million, and I've stayed under $100 million just because of liquidity and all kinds of other reasons. I didn't want people to copy my trades through a 13F or whatever. So I don't care about that as much now as I used to. But I've always kind of wanted to stay more boutique. We've got a 2 dozen or so affluent clients who I know really well, and they don't distract me. That was all. That's been a problem for all of us. Is I manage money for other advisors, and I used to tell these other advisors the thing I learned from doing that the last decade or so, which we've kind of quit doing that now. We do it on a limited basis, but we don't do it as much as we did. Advisors are as bad as their worst client. Advisors are as bad as their worst client. If you're managing money for an advisor, their communication with you is going to sound like their worst 3 or 4 or 5 clients, because their worst clients are the ones that are always whining about it, not being up as much or not being going down, whatever. Their client feedback, their worst clients are the ones who pester them about short-term performance, and those advisors are communications and relationship people. They're not money managers. They're not tactical traders with an edge. If they were, they wouldn't be dealing with us. So they tend to act and sound just like their worst clients, and I would just tell them that, because ultimately we don't really need their money. So I would just tell them that you act like you're which one of your clients is saying this now. And so my point is, that's a pretty harsh way of saying. The point is that advisors act like their worst clients, because their worst clients are the ones that are pestering them, calling or emailing about short-term performance.
It's like emotional transference, right? They get upset, and then the advisor can't help but, because they're human, get upset, and then that permeates across everything in their communication.
That's precisely right. And then that's what they're trying to come to you with, which for me is quite a problem, because I've had to be, and all of us that do this have had to do this. It's not just me. You have to be very, very careful not to let outside influence affect your decisions. You can't be thinking, well, gosh, if I buy gold here and it goes down again, what's Jim going to think? If I buy, utilities, or if I short REITs, what's John going to think? You can't be thinking like that. And we all go through that in the early days. I mean, I certainly did. I think everybody did. You're all, in the early days, your newest, earliest clients are very meaningful, and they all are, but especially in the early days, and they tend to have more direct contact with you. It's almost more of a brokerage type relationship. No matter, even if you're running a private fund that they can't see what you're doing, you're getting, your communication tends to be more over time. To be able to trade your own capital, which is what we do, plus trade capital for other people too, over time, you need to have that core group of clients who get it, who just get it. They understand, they get it, and you're going to probably have to spend a lot of time with them. But the whole point of it is, to address what you were saying, is it's not enough you don't matter how good your risk adjusted risk reward and asymmetric returns are. You've got to get those clients to be able to accept it too. And if they're the kind of if they're a surgeon who's doing surgery all day or doing dentistry all day, and they're going and looking at their CNBC in their office once or twice a day, and following whatever they said, and they see that there's stocks on the screen that are up 20% and they're not in them, and they want to make a comment about it. That's the kind of stuff that we go through early on. Over time, you got to be able to get those people to get away from those bad behaviors, because watching it closely does not change the outcome for them. It doesn't matter if they're watching CNBC for an hour or two a day or whatever. It doesn't help them. It's not, they're not going to get an edge from that.
Yeah, no. And I will say it's that point about having a core investor base that gets it, is a process in and of itself when you're managing other people's money, because you don't really get to know somebody's risk profile until they've actually seen and lived through a drawdown with the advisor, right?
Exactly.
And it's even worse, right? Because the short-termism, because people feel that they can get in and out, the looking at the right of the equal sign as opposed to the left, makes it even more challenging to find the core audience that really gets what you're doing and actually read a prospectus or looked at the underlying research beyond the small sample of today. So it is and only those that are in the industry and in the business really can appreciate that, because we see it often.
Well, it's funny. I talk to a lot of, I try to help other traders as much as I can. And I've done that for a long time. And I did it a lot more, 20 years ago, probably, than I do today, which is why I'm kind of wanting to, do it more now, because I've actually got more, time on my hands now than I did. And frankly, I enjoy kind of helping other people and try to find their edge and all that. But I'm not going to be one that's going to be running subscribers and having the newsletter and the that kind of thing. That's good for some people, but or really what I mean, not so much the newsletters. I mean the training where I did training programs 15 years ago where I had some PMs come to my office and pay $5,000 or $10,000 or whatever to come and do 1 or 2 days on money management and risk management techniques that I use, and kind of help them. Everything has to fit you and your own strategy. So what I do is not necessarily going to work with everybody else, and there's a lot of things that I do that I never disclose and probably never will disclose. Well, maybe one day, but the details about it. Of course, it wouldn't matter anyway, because even if it's just like Richard Dennis said about the turtles. Even if I disclosed, I think it was Richard Dennis anyway. Even if you disclosed all the details, people naturally do not focus on the most important things. They gloss over the key parts, and they everybody's more focused on picking of stocks and all that, as opposed to the things that really create your outcome. I think that so that's really the key. But it's a huge advantage for us. What I was getting to is that I did an interview about a week or so ago with Google with Richard Moglen from Trade Line, and those are more independent individual traders, and they're also stock traders more. And so I know the audience is different. Well, they have a huge you have an advantage of trading your own money. But now, I mean, let's be real. Anybody who's, a successful investor or trader, if you're not managing money for other people and earning some rewards from doing that, which is, by the way, both monetary and personal, because there's nothing like. I mean, I've got families that have been invested with us for over 2 decades, and it's been it's a life-changing experience. I mean, we've guided them into some, not just the money management, also some major estate planning and various things that we've done, selling of properties and things, selling of businesses. There's a lot of things I've guided people through that's made a tremendous difference. And I'm talking, big trust accounts for grandkids kind of thing. And it's been directly related to what we've helped them to do. But it's also a huge advantage in that we, as professional money managers that have clients, I mean, I've seen every mistake in the world. When they started talking about cognitive biases, well, yeah, I mean, that didn't become popular until later on. But man, in the 90s, if you're trading stocks with people and trading options, even more so, options were even more, that's
yeah, and we should save that, because that was a topic I want to hit on for maybe another space on cognitive biases. But I have a I do have to
Yeah,
hop because we're at the top of the hour here. But listen,
okay.
everybody that's here, please make sure you follow Mike. Mike, I mean, you've got a lot of experience. Obviously, I enjoyed listening to your talk here, and hopefully it was worth a while. So thank everybody for joining. I'll do another space tomorrow. Thanks, Mike.
Sounds good. Thanks.